Is the current AI rally gonna last, and are we in the midst of a bigger picture bubble? As we all know, folks, the last 6 months have been sprinkled with AI on every single headline. This seems to be the new technology that people and companies are focusing on, and it's for good reason because it provides a lot of benefits to a lot of companies. Whether it be Nvidia, Microsoft, Google, or Facebook, AI is dominating software companies at a level that we have never seen before. However, because this AI-themed rally has sparked some seriously high valuations in many companies, whether it be Nvidia or C3 AI, investors are questioning whether or not this is reminiscent of what we experienced back in the 1999 tech and telecom bubble. The question on everybody's mind is whether or not we're at the top of this bubble or at the very beginning. Now, to many people's surprise, this AI theme has lasted a lot more than just for 2023. Most of the companies that are currently investing in artificial intelligence have been performing outright crazily since 2008. They've beaten the index and the returns of most bonds significantly, and it's for good reason because these same companies also happen to be in very high margin software industries. If you look at the top big AI names that are thrown around in the market today, the names are dominated by the likes of Nvidia, Palantir, Microsoft, AMD, and C3 AI. Although some of these companies and most of them are quite big and multi-$100 billion market caps, there are a few companies like Palantir and AI that are small caps that tend to be in some cases unprofitable. And what this has resulted in, as you can see, is this massive divergence between the performance of the mega cap stocks, which are the top 8 biggest companies in the S&P 500, and the large, mid, and small cap indices. The list in purple is trading at 29, which is 8 companies like Amazon, Microsoft, Google, Tesla, and Apple. Whereas the ones in red and blue and green are your other 492 companies, which, as you can see, are trading at PEs of 13.5. That is significantly lower than the mega caps and really is a stark contrast to what we experienced in the dot-com bubble of 1999. Because as you can clearly see, back then PEs for large caps as a whole were much higher than where they are today. And it's not just the S&P 500. Even the high-tech Nasdaq's forward PE right now is significantly lower than where it was at the peak of March 2000. And although today we are still trading above the average of where the historic PE has been, when comparing it to the bubble of 2001, we are nowhere near those levels, which means either we have more room to go in this AI bubble, or there's a chance that a bubble like that never materializes. And as for what it would take for such a bubble to materialize, in my opinion, it's going to be 2 main things. You're going to need excess liquidity, which is going to come in the form of lower interest rates and more borrowing. And second, you're going to need more IPOs and more companies take part in this rally. As you can see, if you just look at Nvidia and Microsoft, the AI rally at the bottom right is nothing compared to the other markets we've seen, like the internet bubble, the China bubble, biotechs, ARK-K, and yes, even Bitcoin. We are at the very, very beginning. And this chart right here essentially recognizes those massive rallies that typically go anywhere from 0 to 100% and then see a collapse of 30% or more. And right now, we are not even close to hitting that 100% mark. What we need for a true dot-com bubble era to materialize for artificial intelligence is simply more participation. Back then, we had new startups that were about a week old, gaining multi-million-dollar valuations and made zero money. However, today, stocks like Nvidia and even small caps like C3 AI actually generate meaningful value for its customers and meaningful revenue. And 90% of these AI stocks are actually profitable, which means they are much more sustainable than the companies we saw back in 2001. And not only that, but back then the composite index was actually weighted significantly heavily towards technology-only stocks, whereas the S&P 500 today has a good mix of industrials, cyclicals, consumer discretionaries, and even healthcare, which at that time was not as popular in indices like the Nasdaq. And although many people today say it's impossible to identify a bubble while it's inflating in the stock market, I'd argue in today's day and age of something like Twitter, they're actually pretty easy to spot. There's no arguing in my mind that AI could be a bubble, but it doesn't seem to be one of the levels of 1999 today. The big bubbles that burst in the past crashed markets and in some cases entire economies, as happened in Japan in the 1990s. However, for now, AI is simply garnering more attention than its competitors and a fair amount of investment dollars, but not all of the available funds in American finance. And that is a key differentiator you want to pay attention to. Yes, the day may come when intelligent investors speculate on AI stocks without care for revenue or profits, but right now that is simply not happening despite the gains we've seen in stocks like Nvidia and C3 AI. And trust me, I've experienced this firsthand because I personally am still invested in C3 AI. I've been able to tell just how crazy speculators have gone, but the reality is these businesses provide a lot more benefit than those did back in 2001. And because of that, the gains we would see in a bubble would be significantly more than we are seeing right now. But there's one big reason: chances of that happening are pretty low. And it has all to do with monetary policy. In this hiking cycle, the Fed is fighting inflation, which it has no control over, which means interest rates are magnitudes above where they were in 1999. And as a matter of fact, we have simply not seen this kind of rate hike cycle since the comparisons of 2004. This means that general leverage is going to be much lower, and IPOs and venture capitalist markets are going to go a lot slower. And that's going to hinder the development of any really crazy bubble developing, which is exactly why AI stocks are right now being limited towards the more profitable and established businesses. Because otherwise you would see all sorts of companies talk about AI in their earnings calls because it is such an easy word to throw around. I personally 100% believe in the benefits of generative AI. I've been hammering the table on this actually for about a year now with my investment in C3 AI. However, chances are you should not be FOMOing into any one of these stocks and chasing companies that you have no business understanding. As investors, it's much better for you to pick and choose the companies that you could run if you were to become the CEO tomorrow. You have to be able to understand the business model inside out and the real advantage that it provides to its end users. And so for those that are dismissing the S&P 500 rally because of this AI mania, keep in mind the bubble is nowhere near where it was in 2001. And for those that are trying to chase this movement, just keep in mind this can take a very long time to play out, and the macroeconomic conditions are simply way worse than they were back then. Whether that information provides value to you or not, I'll let you decide that for yourself. As usual, folks, let me know your thoughts on this situation down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.